Hi, I'm Jared Nelson, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're looking at concepts that can help us to give equity markets a health check, that also provide investors with a heads up into the underlying momentum in a market. The metric that we are going to be looking at is market breadth. Market breadth means different things to different people, and as such, there are numerous ways in which we can try to measure or quantify it. But what each of these different measuring systems have in common is that they are gauges of participation. And what they aim to tell us is just how many members of the crowd are joining in the party. In this case, the crowd is a group of stocks, typically an index such as the S&P 500, or a universe of stocks such as all listed US companies. You get the idea. By measuring the degree of participation among these constituents, we can gain an insight into what's driving a market or group of stocks in a particular direction and how likely that trend is to continue uninterrupted. That can be very useful information if, for example, you are considering putting money into a rising market but don't want to end up buying the top. Or if you have been watching a falling market looking for buying opportunities but don't want to jump in hastily only for it to sell off even more. So, how can we measure and track market breadth? Well, there are various methods, some that we can calculate for ourselves and some where the work has often been done for us. Which system you use will really depend on which one speaks to you and how much time you can allocate to working the figures out. Some platforms use a mathematically derived model that determines the percentage of stocks that are in either a bull or bear trend. This measure is known as the Bullish percentage index and ranges between 0 and 100%. Similar to RSI, there are overbought and oversold levels for the Bullish percentage index found at 70 and 30% respectively. The Bullish percentage reading for a market moves daily as individual stocks change trend. The reading rises as the number of stocks in a bull trend increases and falls as that number diminishes. If we look at the current reading for the S&P 500 Bullish percentage index, we find that it's around 74%. Over the last decade, this measure has been as high as 87% in 2013 and briefly dropped below 2% in March 2020. An alternative measurement of market breadth can be made by comparing how stocks are trading relative to a key moving average. And the one that many Wall Street analysts use is the 200-day moving average. A moving average is simply a rolling record of the average prices of a security over a predetermined period, in this case 200 days. We can compare the performance of a stock to its 200-day moving average in isolation, and that can tell us a good deal about how that stock is trading now and how it may trade in future. However, we can get an even bigger insight if we look at how all the stocks in an index are trading relative to those averages. We could do that by looking at the charts of the individual stocks in the index, with the 200-day moving average line drawn on them. That might be okay for the 30-strong Dow, but it's not a practical proposition for the S&P 500, for example. However, these days many charting systems and websites carry this information and calculate the number of stocks that are above or below their respective 200-day moving averages, and that data can be plotted as a line on a chart itself. In this chart, we see a line that plots the percentage of all US listed stocks trading above their 200-day average over the last 20 years. Currently, around 88% of stocks are trading above their average. That could mean one of two things. Firstly, that stocks are cheap compared to history, and that earning and growth in 2021 and beyond will be more than enough to justify prices trading above the long-term averages. Or it could mean that the market is increasingly being priced for perfection, with the majority of stocks trading above their long-term average price. In that situation, it's much easier for the market to disappoint investors because so much expectation has already been priced in. We will leave it for you to decide what the right interpretation is. However, Bank of America research suggests that returns in the S&P 500 dip following a spike in the percentage of stocks trading above their 200-day moving average. Currently, 92% of S&P 500 stocks are trading above that level. Let's finish by noting that according to our TrackStar IQ, our proprietary research tracking tool, the lion's share of professional investors' ETF focus falls on high-growth S&P 500 funds. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.